Hello, my name is Tree Demon, and I'm the Devil Stockbroker. Thank you so much for tuning in to watch this video. Before we begin, please understand I'm not a financial advisor, and none of the following content is financial advice. The following content is for educational and entertainment purposes only. Trading stock carries inherent risk, and you should always respect and understand your own personal risks when considering any investment. Please don't take what I say as gospel, and please do not trade based on the information that I receive and share through my content. Thank you so much, and have a hell of a time in the stock market.
Hello, everybody. This is True Demon, and this is the professionals meeting for May the 29th. Happy Memorial Day, everybody. Hope you guys are having a good weekend so far. So, normally this meeting is for the professionals to talk about anything that they want to, but we're doing something a little bit different in that I've got got a handful of things that I'm going to be discussing for the rest of the team. Um, so we've got some DD to cover about the housing market and the general market overall. So I had a Twitter thread that I published earlier last week regarding MBS and mortgage-backed securities, and quite a few rather terrifying markers that are coming up ahead of a massive market event. And I wanted to take the time to put all of this together in a single video for absolutely everybody, because this could be one of the largest financial events in the world. There's a lot of things happening that have been snowballing over the course of the last 8 years, and as I've been researching this more, I've been away for a while, guys, but I have not been just sitting on my ass. There's been a ton of research being done. One, to try to improve my trading and figuring out some new strategies that will help us profit the most, and also get the best entries on certain stocks whenever we see things turning in our direction. And we'll cover that a little bit later. But right now, I wanted to focus mostly on what's going on with current events in the world, and why the hell is the SPY pumping right now when we have so many factors that are whispering in our ear that something big is coming and it's not good. So, S&P 500 is the barometer of the entire US market economy. Typically, we look at the SPX, which is the index for the US top 500 companies according to Standard & Poor's. SPX has been the classic example of how the US economy and overall stock market is doing for at least the last 80 years. Standard & Poor's, just like Dow Jones, has been around for a very, very, very long time. And we can see every single market crash event that has ever happened, such as the Black Monday crash of 1987. This was it. It was the 19th of October. This was when the automated trading systems had been, well, this was after automated trading systems and computerized trades had been introduced, and we didn't have circuit breakers at the time. So I've been studying all of these market crashes, all of these big events that happened in our past, and there's plenty of crashes that were black swan events. Like 87 was because the computer system for the exchanges allowed for automated systems to trade so quickly that the market fell so rapidly that nobody was able to react, and basically everybody on Wall Street was completely caught off guard, and people's accounts went to zero overnight. People got margin called in the span of just 5 days. That's all it took, was 5 days. So anyhow, things were pretty nasty back then. Going even further back in time, all the way back to the legendary 1929. So the 1929 October stock market crash was perhaps the greatest stock market event that led to the biggest depression that our country and, in fact, the world had ever seen. So I'll get the Dow Jones Index because S&P 500 didn't really exist then, at least not as it does today. So back at that time, the Dow Jones was the 30 biggest companies in the United States, and this index had fallen to its lowest level. It was the largest overall drop in history. The entire Dow Jones Index had lost, I believe it was something like 80% of its value in the span of 3 years. It was bad. So this was the worst period in the United States economic history at that time. So a little bit of backstory here, because it relates to the world events that are going on now. And I want to preface this by saying that everything that happens in history seems to happen in cycles. We don't understand exactly why, but humans are quite predictable creatures, and as it turns out, over time, our predictability plays out in repeating events of history over time. And one of the largest ones are rise and fall of empires. So the Roaring Twenties was a period of extremely powerful economic growth. The United States was experiencing a lot of geopolitical turmoil at that time. We had prohibition going on at the time. We had just come out of World War I, which the United States hadn't necessarily participated in very much as a military, but there was a huge arms race, and we were one of the largest providers of military arms, small arms, firearms, ammunitions, and fuel to our allies in Europe, and all of that caused the U.S. economy to boom, and it led us on the path to becoming one of the most powerful economies in the world. At the very end of World War One, there was the largest pandemic and the most lethal pandemic that we experienced in modern history in the form of the Spanish flu. Um, Starting in 1917, it was also called the soldiers' flu. That was contracted by soldiers coming back from Europe, that they had gotten. It was a very unique strain of H1N1, as it turns out, swine flu. But in any case, the um, the the disease was extremely lethal. It killed, I believe, it was more than 500 million people globally. I'm not sure if I've got that number right. It was a huge number of people killed in a short period of time, and then after it decimated the entire Western world, especially in Europe, it completely devastated their economies. And the United States, despite also having been affected severely by it, recovered the quickest, and our economy boomed extraordinarily well. At the same time, we went through a major housing boom, a giant housing bubble that was created over the course of many, 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 many years, going on from 1921 up until 1929. And it precipitated when finally fears of inflation and the massive amount of money that was held on credit through margin. Margin did exist this time. Margin stock market investments, as well. There was actually individual, you know, average people at this time, which just wasn't common before this point. But average people were getting invested into the stock market. People had more access to it than before because they were able to make stock purchases through broker banks that had telegraph services and telephone services, and that allowed average people access to the stock market. So it became a utility and a vehicle for average individuals to make investments. But unfortunately, because the average person wasn't highly educated at this time, literacy was very poor, and so on and so forth. It led a lot of people to just throw extra money into it without really understanding it, and although at that time there wasn't many devices where they could get themselves into trouble with, it did create this huge bubble that resulted in the rise of the Dow Jones by more than 500% from the beginning of the century till the end in the span of just under 8 years. That's how far the Dow Jones had come. And in fact, in the final year from September, we'll go from the low from June of 1928 till September of 1929 when it reached its peak. The Dow Jones Index had increased by 91%. And almost all of this money that had been generated up here was margin. Tons of this cash that was put into the stock market was borrowed, which means that anybody that had their stock portfolio go against them would not have the credit and they would not have access to actual collateral cash in order to pay it off. And this is what led to the massive crash that occurred on Wall Street back in 1929. Why am I telling you this? Because this is the kind of event that we are looking at now. It's very difficult to get any data back here, so I can't. There was no volume being tracked back then. Honestly, that kind of makes sense because there was no computerized trading of any kind. Um, so we'll have to look at future events to kind of get an idea of what was going on. As a assistance to us, I've gone ahead and I've grabbed a few. I've gotten a few indicators together that will help us track some of this data and hopefully hopefully figure this one out and notice the trends that occur in these markets. But one thing that I want to point out to you guys is my smooth moving averages that I'm using on these charts. I'm going to be using the 50, the 100, and the 200. This is pretty close, but pay attention to these lines, these trends. When all of these lines are going up in the same direction, it's a bullish market, right? This is the basic principle of smooth moving averages. Everything is going in the same direction with the price. And look at how far of a gap there had formed over the course of the weeks in all of these moving averages. The bigger these gaps are, the more volatile the move against it can become. It's just a principle of the markets that whenever there is a major move there where the price is staying with trend and exceeding trend for such a long period of time, that the crash or the correction can be twice as severe. And it's kind of interesting that in the span that it took the Dow Jones to move by 93%, that was almost a year that it took. It was able to make that same move back to the downside in 70 days. It only took 2 months and 10 days for the Dow Jones to return to the point that it had peaked at a year previously. So let's go a little bit forward in time. And let's go and look at some of the evidence from more recent history that can kind of give us an idea of what we're in for. We'll go to a weekly chart and we're going to go back to watching the SPY. I know I've got a lot of lines here. Hope you'll just excuse my dirty charts. S&P 500. What we're looking at here is the two bubbles that formed from the 1990s all the way up through the subprime crash and the massive crisis, the giant financial crisis that happened in 2008. Before the 1990s, we had just come out of a huge inflationary period, the worst one that we had ever seen. I believe the high water mark of our inflation at that time was something like 13 or 12% or something ridiculous like that. I'm going to throw a few other things on here. We're going to look at inflation because that's always fun to talk about. So inflation. In the 1970s, we went through a stagflation period, which is it's a really unique, catastrophic series of events where the economy is in a period of complete stagnation in terms of job growth and economic production, as well as high inflation. So the three factors that tell us that we're in stagflation is when inflation is out of control, more than 5%. Anything above 8% is pretty catastrophic. Anything above 20% is considered hyperinflation. The other two factors is GDP growth is decreasing or stagnating for more than 2 quarters at a time, and unemployment is, I believe, over 8%. So extremely high unemployment, very high inflation, and a lack of growth in the overall economy. So we went through that in the 70s. And back then, the Fed had to do something extremely aggressive to get it under control. What the Federal Reserve Bank's job is, I want to give a little bit of background and history so that people understand the purpose of the Federal Reserve. The Federal Reserve Bank is meant to be the central monetary policy enforcer of the entire United States economy. They are not just a money printer, they're also managing the entire economic policy for the nation. Their job is basically to create job growth, to create production, to ensure that our economy is flourishing, and to create investment opportunity and ensure price stability. Price stability is defined as keeping the stock market under control so that the growth is stable, steady, and consistent and doesn't go out of control in one way or the other. So avoiding massive crashes that would cause the entire economy to evaporate while simultaneously preventing the stock market from going into this huge bubble, which is a byproduct and, in fact, a complication of inflation and can cause more inflation. So the Fed's job is not just to print money forever. It doesn't work like that. The Fed's job is to maintain stability of the economy. That is it. So in this period when inflation had gotten so severely out of control, the the result of that was the entire stock market crashed. Why did that happen? That's because interest rates rose. So what the Fed has the ability to do in order to fight inflation is they raise interest rates. Raising interest rates makes money more expensive, makes it more expensive to get a loan. And when you take out a loan, the interest rates are higher, so you're making more payments based on that's proportional to the size of your premium. Anything less than 2% interest rates is basically like that's just there's no there's it's like free money. It's next to nothing. You get almost you have almost no big payments. You could pay off the same loan over the course of years as long as you're making more than 1% profit off of that every single year, then you're fine. So 1% is not going to hold back banks and investment firms and the general economy. It's basically printing money. So when the Fed set the rates down to ridiculously low levels, it allows for all of this money to enter into the economy. They pump out all of this cash through lending programs. Basically, the Fed trades bonds with the banks, where the banks say that they will agree to purchase those bonds at a higher price at a later date. So the banks take that money, they say thank you, and then the banks go and lend it out to all of their customers so that they can generate funds and income off of that money and then go back and pay back for those bonds later on. This is the process of repo and reverse repo. So when you go through this period in a significant for a significantly protracted period of time, you have a rise of inflation because there's more money going out into the economy. The banks are doing more with it. It becomes easier to lend money. The lending practices kind of the lending standards, I should say, are allowed to decrease because the banks are able to hand out so much money. It doesn't matter if a majority of them default. The only point is that they're able to make enough money with all the loans that don't default, where people are consistently making their payments, that they make a good, consistent income and they grow that money. And then that begets more inflation over time. Now, once things get out of control, the Fed has to raise interest rates to make those loans more expensive, force the banks in order to make them not be as eager to lend out that money, make them put it into investments that are safer, that have a more, shall we say, consistent rate of return, and keeps it out of the economy. These are things like bonds, such as treasury bonds, company bonds, pension funds will purchase bonds in specific companies, especially very safe companies, big companies, banks, oil companies, or whatever stable commodity is being produced in the country. So after having given all of that history, this massive inflation period that we went through back in the late 70s, in order to get this under control, this had gone out of control for so long. They tried to fight it briefly in the early 70s and they got it down a little bit, but then things started to go out of control again because we had gotten off the gold standard, so money was being printed and pumped out into the economy nonstop. Nixon took us off the gold standard, and by this time, the United States dollar became the world reserve currency. That's basically the currency that every country agrees is legal tender and they have to accept it, and that it's a good currency to exchange internationally. This led to more and more and more and more inflation. And in order to get it under control, they had to raise the interest rates to a freaking whopping 20%. It made it almost impossible to get a loan. And believe me that it did create an environment where a crash could happen. And in fact, it did. It crashed the economy at that time. The S&P had been on a roll for a long time. The Dow Jones is even more ridiculous because S&P is still pretty young in this point of its history. But you see that when the inflation goes up and they start to raise interest rates, these big flash crashes from the Fed constantly trying to raise rates and slow things down, it creates this panic in the market over and over and over and over again. You can see it every single time. And we've gone through a long period of growth in recent times where inflation has once again gotten entirely out of our control. So, the thing that I also want people to keep in mind is that how we measure inflation is with the Consumer Price Index, CPI. You've probably heard this term before. What I found out over the weekend is that the CPI that we use to judge our inflation levels from back in the 70s is not the same CPI index that we have today. And in fact, our CPI index is so limited in its access to the commodities that it measures that it's almost totally ineffective at tracking inflation. It's actually greatly underestimates it. Yes, Chandra, thank you for pointing it out. That's exactly what I'm saying. The CPI is doctored. It's the Department of Labor Statistics, which is in charge of the CPI index and generating those numbers every single month. They are horrendously underfunded, and the system that they use to track it is almost useless. I would say honestly, like it's it's next to it's next to useless in tracking the actual inflation because the CPI index is it's basing its inflation off of the price of common goods and commodities, but it's not tracking one very important thing: housing. The CPI index does not track house prices, and it is the one biggest commodity. It is the largest commodity of the entire United States. The housing market is our equity. United States the United States housing market is the thing that helped us to escape the depression. I want to point this back out. 1929, the stock market completely crashed and all the banks shut the fuck down. All the banks stopped lending money. Margin calls happened back at this time when this crash occurred, and it wiped out even the wealthiest of investors' bank accounts completely. There was a massive reset in the economy that caused anybody who was in the stock market, that was in these major stocks, and of course they were all in these major stocks, that cratered. Anyone who wasn't actually on the floor of the exchange in Wall Street got flushed out. And what this led to was the Great Depression of 1929 all the way up through 1930, about 1935 or 1937, thereabouts. Now, the Great Depression was marked by a massive amount of poverty, joblessness. People weren't able to find homes. People weren't able to buy food. You had these lines around the block for soup kitchens, and you can look at the images on Google from history, and it really was the worst economic event that had ever hit us. And we don't even truly understand the scale of it today because we didn't have the technology we do now to track just how many people were down and out of their positions um, at the worst of it. The reality is probably far worse than we can ever truly understand because we can't go back retrospectively and look at all of the data. But the one thing that we do know is there was a massive, massive, massive amount of homelessness, and it was because people couldn't get loans for banks. So in 1933, this was when Franklin Delano Roosevelt came into office. He came into office and he was sworn in January of 1933, and Franklin Roosevelt immediately wanted to fix the economy. What he decided to do was he decided to insure the loans of mortgages because he wanted Americans to be able to afford to get a home. The biggest problem that was going on was that America had all of this empty real estate. They had tons of empty homes. People were living in shanties and shacks and they couldn't find work. And it was a huge problem. Construction had stopped. Nobody was producing anything. Nobody could afford a loan to get a business started, and everything was just completely halted. So in order to fix this problem, President Roosevelt enacted God, what was that act called? Ah, this is it. This is it. The Homeowners Loan Act of 1933. This was also widely known as the Great New Deal or the Big New Deal. So Franklin Roosevelt, he was an incredibly intelligent guy. He's probably one of the best presidents that we had just because of this one decision that he made in order to fix our economy because he came to the very powerful realization that the housing market in America is what made America so valuable as a country. And when he decided to do this, he basically ensured every single American the right to get a loan just to purchase a home. And this is the reason why we have things like Freddie Mac, Fannie Mae, Ginnie Mae, and all of the U.S. agency loans that are backed by the United States government. So when you get a Freddie Mac or a Fannie Mae loan, you are getting a government insured loan. And it's because of this act that we have this. Franklin Roosevelt was a big believer in common welfare and things like that as well. So he ensured that people had access to food, electricity, and basic utilities as well. But this was the big one. This act made it possible for us to come out of the Depression. So 1933 is when that turnaround actually occurred, and you can see it in the Great New Deal early in 1933. The stock market started to come back to life almost immediately, and over the course of the next 3 years, we were back to where we were at the beginning of 1928 when the stock market was basically put into a bubble. There were these little mini micro crashes, little corrections in the stock market at that time. It took us a long time to come out of it, and as well, we also had World War II after this period. So we got a hit. World War II started. Germany was invading its neighbors in Poland, And then we got attacked at Pearl Harbor in December of 1941. So then we went to war with Japan. So lot of events, a lot of big events happened in this time period that led to the stock market kind of basically doing nothing for about a decade. Um, but immediately after that, the economy boomed. The world reserve currency was established to be the United States dollar, and ever since then, we've just been in fucking euphoria ever since. The United States economy became the definition of stable, and that history has continued, but at a great consequence in that we believe that we are too big to fail, and we have created all of the tools of our own destruction that could possibly ever be needed to eliminate us as not only the world reserve currency but as one of the greatest superpowers in the world. So I hate to make it all sound so doom and gloom after like that rousing speech of like, oh yay Freedom Eagles and American Budweiser, but we've quite I'm being serious when I say that the situation that we have created for ourselves now of all times is leading to one of the greatest market disasters that we've ever experienced. So I want to go back to the S&P, and we're going to take a look at the previous crashes that occurred before this. So all throughout the dot-com boom, that's what this one is, and then we have the financial crisis of 2008. That's what this is. You see, inflation never really got too out of control. It peaked at about 5.5% at the worst point of the economic crisis in 2008, but inflation never really got under control. Never really got out of control. So for right now, we don't need it. Go ahead and drop that out of there. The S&P 500, when the tech bubble started, tech was new. Tech was very novel. Tech was, it was making people's lives easier. Everybody suddenly got access to home computers. Microsoft was added to the New York Stock Exchange, and we had all of these fantastic, novel, new companies, all exciting, just coming out into the stock market, and tech was just huge. And that's what created this bubble, was just the idea that tech was new and it was going to change everyone's lives, and everyone wanted to get a piece of it. Um, and for the most part, I would say that it was good. But where the dot-com bubble went wrong is the same reason for all of the other previous stock market crashes: is people get too ahead of themselves. They get too euphoric, and they get too excited about the possibility of, stonks only go up. That's that principle. It's funny to joke about, but it really is how people think in these situations when, the stock market's just going up forever and it'll never stop. And that's what people think. And it can't go that way forever, because that's what leads to situations like hyperinflation that make the dollar worthless. So it can't go that way forever. And then as soon as the Fed had to raise interest rates, then, things fell apart again. And that's exactly what happened in the dot-com bust. Is, the Fed had to get things under control, so they started raising rates a little bit, and unfortunately, like, it got out of control and people got margin called um, at about the time that the tech bubble returned to its point, when it dropped out here. Um, at the point where it had started in 1999. And at this time, like, this was the worst bear market that the United States economy had ever seen. This was the longest and most severe bear market other than the crash of 1929. And people got margin called. I want to use this tool called the fixed range volume profile to show something. This is from the beginning of the bubble to the top of the bubble, and I want to show exactly, this is where all of the trading volume was from the beginning to the end. Okay, and I want you to take notice of the fact that most of the volume down here is pretty small. Like, this was a good period.
1993 to 1995, those were some good years. I remember seeing my home baseball team going to the Division World Series, and I really enjoyed I really enjoyed all that time. So like the early 1990s were great. I remember life as a young kid then, and things were just awesome. But the economy didn't really move much, and there was this big you know halt in the economy. Things didn't really move much. But immediately after tech started to take off in 1995, the stock market started to rise. And notice how all of this volume that happened here, almost all of it is below is before 1995. This is a lot. This is a lot of volume, right? And this is where the average, or the heaviest weight, this red line that you see here, this is the heaviest weight of volume, of trading volume, where you could consider prices to be stable. If you go back even further, you would be able to see that, most of the trading was still done here. Even if you go all the way back to November of 1990, you would still see the heaviest load of volume occurred in this area when prices on the SPX were between 430 and less than $500. But as soon as you exclude that data, as soon as you go just a little bit past 1995, the weight is up here. Why does that happen? Well, during this entire period going up into here, the slow roll of stocks becomes a little bit more euphoric, and the thing is that this is causing price to move. Um, no, we talk about volume and price movement a lot, and I want to explain that volume creates volatility. And we understand this in principle when we talk about our meme stocks, like we want it to go up rapidly so that we can cash out. But the thing is that requires a lot of volume in a single direction. And what that does is it creates a huge gap. It creates a huge gap in volume where the price is not stable. If you go if you can think about this line and you can create another one, let me try to do that here actually. I'll, I'll, I'll just have to create a second one here. So if I create two of these, one beginning at early in the early 90s and one excluding the early 90s, we get this. Now, if you can think of this as support and resistance, then it kind of changes the story. Notice there's a huge heavy weight of volume way down here, and there's not a lot of volume in between, and there's a fuck ton of volume way up here at the top. If you think of this like a fulcrum or just like basic physics, you've got a really stable foundation here, and you have a really heavy weight standing on a pole. And as this weight gets heavier, it will become less and less and less stable, and eventually it will tip over and fall. And that's why you need to have a stable foundation for any tall building. If you build something really tall, if you make it too top heavy, it doesn't matter how strong this foundation is, because if the weight at the top is too heavy, then it will have more leverage to topple the whole damn thing. This is what happened in the tech bubble. We had price surging to ridiculous levels, and then things started to get really, really, really stable here. And, it gets a little uncomfortable at that point. The price has been going for 5 years, and the tech sector was doing really well. And what should have been our first clue that things were going to turn around is the moving averages. Looking at the moving averages, we see that everything starts to turn around. Okay, we've got the 10, the 20, green is the 50, orange is the 100, and red is the 200. And this is a weekly time frame, so this is a very lagging indicator. So let me actually go ahead and switch this to a daily. We'll get a little bit clearer picture, I think. I gotta go way back again. Wish it didn't make me do this. I wish it would just hold its place. It would be much more polite of my charts.
Okay, here we go. So now these are daily moving averages. Again, we still have the 10, the 20, the 50, the 100, and the 200. And the thing that should have really clued us in was after the 50 crossed below the 200. This is known as a death cross. Okay. And it's just the opposite of a golden cross. When the 50 crosses above the red line, that's known as a golden cross. And the market's good, and it's a reverse of trend to the upside. The market's going to be great. Everybody's happy. When the green line crosses below the red line, that's a bear market. That's bad. We're not in for a good time. We're going to have to sell some stock, and we're probably going to have to go short on things if we want to make any money. This is the classic example of when a stock is going into a downtrend, and you never want to trade against the trend. And I have been an idiot in that I didn't really learn how to look at charts in this way. I have had such an enlightening experience over this weekend after I've been watching so many videos and reading so many books and articles on trading that I've now come to see how obvious my mistakes have been in the past, that if I had just known about these very simple fucking tools, I could have avoided making so many mistakes, and I would have known to get out of positions, and I would have known when to go short on things. And I have every intention on passing off everything that I have learned to you guys, but that'll be a little bit later. So I want to go ahead and finish this up with our little story on how to look at market crashes. So as I mentioned before, this is everything from the beginning to the end, or from the beginning to the peak of the 2000 bubble. So the 2000 bubble. If you think of this red line as like support, because the price, if we imagine that we're at this time period where the S&P is it's like near all-time highs, and everything is great, but we see that there's this big red line of support because all of this trading happened far, far, far below us. And if we exclude all of that, if we go way back in time, come on, Trading View. If we go way back in time and exclude all of that euphoria, we see that this red line is a big area of support. If we just exclude the peaks, this line still stays way down here. All of a sudden, things start lifting towards this side after November of 99. Look at how much of a difference that makes going from September to October of 99. Lock this into your brain. This is support before September of 99. Now, this could have been the top. We wouldn't have known if we were trading back in August or September of 99. We wouldn't have known. But the moving averages started to cross down, and they started to go against the trend. But the 50 never crossed the 200, and it bounced, and it kept going. Whew, all right, we're okay. We're still in a bull market. But we need to take note that after we came out of that rally, that our support is up here. So we need to mark this. We need to pay attention to this, because below this, there's a lot of air between us and the ground. There's nothing here to catch us. And we need to remember that. So continuing on, we're here at the peak, and our support has changed. We've got all of this volume below us here. So we've got two levels of support. Now, what should have made us nervous is that after October of 2000, the market dropped and it tested this support. And it came up and it got rejected by the previous support that became resistance. And also, now we've had a death cross. So now we've been rejected by the 200 moving average. We were rejected by our previous area of support, which now this has become resistance. And now we're retesting. Now we are retesting our last support before all of this area between us and the ground.
So these moving averages are very telling. You see how the moving averages themselves and the price keeps getting rejected off of first the 200 and then the 100, and then the price starts to really come down. And the rallies get pretty violent, but overall, the trend is very much against the market. And this is because the momentum has changed. And at this point, the collapse is pretty inevitable. Now, we didn't fall all the way down to the beginning because this was still just purely playing out in the stock market and in the banks because, the banks had been lending out too much money on margin and people got a little bit too excited. And, they were in for a reality check. And that's what caused this market crash. And it had to happen. Every market crash happens because it must. Things can't go up forever. It's just not the way it works. Money can't be infinitely generated because if you do that, it stops meaning anything. So we learned our lessons from 2000. Perhaps we'll do better in 2008, but probably not. So what I want to point out, I'm leaving the bottom from the 2000 bubble in place, and notice how close the financial crash of 2008 came. This drop and the fact that we returned to where the stock market was almost a decade ago, actually more than a decade, 14 years, we returned to levels that we hadn't seen for 14 years. That's how bad this crash was. So there's a lesson in here for us. And for this, I'm going to switch over to the SPY. This is the bottom of the .com bubble, by the way, right here. So we're gonna go look at the SPY's crash during the 2008 financial crisis. Well, before I do that, I should give some preface because 2008 is going to be far more like what we're about to go through now, but on a scale of the crash of 1929, because it's going to take a long time for it to reach the bottom. But at the very least, I do want to I want to give some background to what precipitated the events in 2008. So we're going on this this video and this meeting became quite a history lesson, but appreciate you guys stopping by for it. Anyway, so 2008 is to date still the worst financial disaster that we've ever experienced because it led to the closure of multiple banks and basically pandemonium across the entire world. And this was the first time that the United States economy had gone through such an event as the world reserve currency to such the degree that it caused the entire economy of the world, the entire global economy, to suffer severely. So let's go reverse time back to 2003, and the market here in 2003 was pretty stable, but this was about the time that the Fed started printing money in order to stimulate the economy and putting it out to banks so that they could give people loans on houses. Because after the dot-com bubble had popped and everything was returning to normal, people were getting really freaking upset that the government wasn't doing anything to kind of return us to normal. And all of the we had September 11th, 2003. We were going to war with Afghanistan. And we were gearing up for Operation Iraqi Freedom. So all of these really bad events, we're talking about war and global conflict. We're talking about coming out of a massive crash in the stock market. Everybody's pretty upset in general, and I won't say one way or the other about how I feel about President Bush, but I'm just gonna say he could have handled things a lot better than he did. And after all of this, something had to be done. So one of the big ones was they decided to start putting money out into the economy by dropping the interest rates and creating an environment where people would be able to afford to get a home.
Um, and the thing is that the market, the housing market was pretty flush. It was actually pretty flush with supply. Construction and available homes were still pretty high at that time, and we can look at that and compare that by looking at the housing supply. So if we look at the monthly supply of houses, you see that through 2003 through 2004, monthly supply was actually pretty low up until about 2006 when it returned above 6. But down here, housing supply was pretty low. So in order to stimulate the economy, uh, the interest rates on home loans was dropped rapidly in order to facilitate lending so that people would be able to build and purchase homes. And at that time, that seemed to work. It brought the economy back to life, and things started to recover pretty quickly. People were able to afford bigger homes. They were able to move out to areas where they could build new land and get a house, and it was good for everybody. Now, where things got really out of control relates back to you can watch the movie The Big Short if you want a little bit of a history lesson on this, but the lending standards were really, really shit at this time. And in addition, there was the banks had figured out something when it comes to loans, lending out mortgages, is that they could make a big killing selling mortgage-backed securities over to the government. Um, and that was part of the bonds that the banks exchanged for cash in the form of reverse repo. So all that I've talked about up until this point has come back to haunt us again here. So remember what I said about the New Deal and the Home Loan Act of 1933. That that led to the creation much later in the late 70s, where I believe his name was Louis Ranieri. He was a Wall Street banker that invented the mortgage-backed security, and the mortgage-backed security, or MBS, was it was a piece of paper that you could hold like a bond. It was basically a bond that was uh, that was going to pay out dividend yields to the investor who purchased it in the form of uh, home loan payments. And the way the mortgage-backed securities work is that the bank gives somebody a loan, and then they give 100 people a loan. So you've got 100 people that have been given out a loan to pay for a house. And people go get their house, they've got their mortgage, and they make their payments every month. They're happy to go to work, and the economy is still pretty stable at this point, even though we're in hyperinflation. But overall, things are pretty good, and the bank's pretty happy with this because now they have 100 home loans that they're making money on, that they're getting an investment on. Now, how they make money on this, but it's kind of slow because there's still the interest rates. The interest rates on those home loans are really high at that time, but now here at this time, like in the late 2000s, interest rates are really low. So mortgage-backed securities, which were originally meant to be a safe investment for pension funds and 401k investments and IRAs, um, they would sell it to those big investors, the banks. They would sell to those investors who wanted a safe, stable device that would ensure consistent returns and had a very low probability of collapsing or defaulting. And that's why the mortgage-backed security was so good. It was a way you could get a very firm consensus on how stable, how good the bond was just by looking at the credit and the income of the people who held their mortgages in that basket of loans. And then you could turn around with that mortgage-backed security. You could give it, the best rating would be a AAA rating, or you could rate it AA plus or AA or AA minus or single A, whatever. And just it was all based on the probability of default. And the best rating, which is like less than half of 1% rate probability of failure, is the AAA rating. And the worst one is it's a D rating, which is absolutely awful, like more than 40-50% probability of default. And those don't really go anywhere. But you have the but
the more common one was subprime. More common one was subprime mortgages, which were less than A rated. So these could be triple B plus, triple B minus, um, double B plus minus, whatever. There's just a whole lot of B's. The rating system's stupid and it's ridiculously complicated for no reason at all. But anyway, you think of anything that's not an A-rated mortgage, it's a subprime. It's dog shit. Because it has a higher probability of default. You know, the people that they may not have stable income, they may be self-employed. If you don't have a stable income and you just declare your income to the bank and they don't have a real way of proving it, then you're probably not going to get the loan these days. But back then, that was fine. They don't care. Why? Because those banks, those individual um, those those banks were able to take those mortgage-backed securities and turn around and sell them to the Fed, and they could exchange those bonds for cash, and they got payments for them. And they would have to, give back little kickbacks to the government, and they would have to give them those yields. But what the banks were able to do was get a giant lump sum of cash right then and there. And the banks can do a lot with cash. When banks are flush with cash, they can do a lot with it. So that's what the mortgage backed security became. And over time, from 2000 up through 2005, the banks were, they were just doing the mortgage backed securities, but they kept getting more and more creative over time. And then they started coming up with a special kind of device, which is way, way, way stupider. And you know what? Just to keep things in theme, let's go put XLRE. This is the S&P's index on the real estate market. Okay, so we're going to talk about CDOs. CDOs are fun. So a CDO is a very special device. A CDO you can think of if you can think of a mortgage-backed security as a basket of homes. So over here you have the mortgage-backed security. You got MBS. And what this mortgage-backed security is just a basket of houses. So you've got a mortgage-backed security here. The mortgage-backed security has a basket of houses, and this is the device that the bank will go ahead and take this. They will take the MBS and they will sell it to the Fed for a chunk of cash, and the Fed in return gets yields on those mortgages. Okay, and because all of these people, they have really good credit, they've got a stable source of income, they made huge down payments on their homes. They've got plenty of cash. If they really wanted to, they could just buy the homes right now. But you know what? They're not going to do that. So we're going to rate this one AAA. This is a AAA MBS. Okay. Now you might have another situation where there's not so many great there's not such great income, not such stable income. You might have people that just lost their jobs or are trying desperately to get a home while on unemployment. Those are a different story. So this might be a double B mortgage-backed security. So say that this is just a group of loans where there's not stable income and they don't have very much cushion beneath them to cover their mortgage payments. So these are double B MBS. So we got these two mortgage-backed securities. All right. Now the bank is looking to get really creative because they have a slight problem. They've got a lot of investors, and a lot of their investors need different types of risk exposure. The reason is because you have several types of investors. You got hedge funds, which are they're generally pretty risky guys. They like to take bets that will yield high returns because they got paying clients that expect them to give them high returns. So they're going to need a way to get those returns as quickly as possible. They're willing to take on a little bit more risk to do it. Then on the other hand, you've got middle of the road investors. These might be private investors that they're willing to take on some risk, but they can't deal with like the riskiest of the riskiest loans. And Then you've got the super safe investors, pension funds, 401ks, mutual funds, and things like that, where returns are expected. They don't have to be super great returns, but they need to be guaranteed returns, almost no probability of failure. And those are what banks usually had catered to. So, how do you get a pension fund to buy into an MBS that's double B rated? Well, you can't because it's not safe. The pension fund is willing to invest only in double A or triple A rated bonds. So, in order to get the pension fund to invest in your device, you need to be able to guarantee them a safe return. So banks created the CDO. This is called a consolidated debt obligation. And the way a consolidated debt obligation works is you have tranches or portions of the loans which are packaged up into this box, and it has three levels. At this, you have the senior level. These are the senior level bonds, and this is where the pensions invest in. Here you have the mezzanine, or the middle level. We'll just call this mezz. And this is where your private investors are probably going to sit at because they're willing to take on a little bit more risk. Private investor. And then over here you have the junior tranche. And this is where your hedge funds invest. Now, the way that this works is you package up all of these loans. Imagine that there's hundreds of these MBS, and they put them all into this entire CDO. All of them go into this box, okay? Now, the way that this works is the CDO has a rate of return, a fixed rate of return for each level. The senior level gets a 1% rate of return, and the senior level gets paid first. So the pension gets their money first. And if for any reason the CDO can't make payments to the other two levels, the senior will always get their money first. So seniors are always paid first. Now, because of that, this tranche of the CDO is rated as AAA. That's a AAA rated CDO tranche. And then you have the mezzanine level, which is going to get paid out at we'll just say a 4% return. And that's a pretty good return for a private investor because private investors can't. A private investor may not have access to more complex devices, so they wouldn't be able to take on riskier bets. But they also probably don't want to. They would rather take a 4% return that's more than likely going to happen. You know, this one has this one they'll probably say has a double A rating, or maybe a double A minus rating. And that's going to get paid next. So if these MBSs, if all these people continue to pay their payments on time, the mezzanine level gets their money and they get their 4% return. And then you have the junior level, which is the last level. They get paid the very last. And as long as absolutely everybody makes their payments, then they get an 8% return, which is great. 8% returns for a hedge fund, that's fantastic. If they can get 8% returns, then they can meet their quota to their client easily within the year. But this is also variable rate, so they may get variable rate returns. So 1 month they may only get 5%, but the next month they might get 8% because everybody catches up on their payments. So that's how the CDO works. You get the senior level, the mezzanine level, and the junior level all paid in descending order at a specified rate of return according to the contract. And this is how the CDO was manufactured by banks in order to convince pensions to buy into these devices so that they could get them to purchase these double B rated loans. And that's the thing. This fucking thing is called diversified because of the diversification of the CDO with all of these different MBS. And as long as the senior notes get paid first, the pension considers that safe. And the ratings agencies went along with this. They were okay with this. You can also do something even more freaking ridiculous, which is you can introduce credit default swaps. So now we're going to talk about another fucking mess called a credit default swap, or a CDS. And the way that a credit default swap works is you have a pension fund, and the pension fund is, they're not entirely sure about this CDO, or maybe the MBS. Maybe the pension fund maybe this is a CDO that's rated as single A. I don't know. The pension fund still wants to invest in it because it's got a really great rate of return, but they can't invest in it because their charter says that they need to invest in AA or better rated devices, and that's the only thing that they can do. So even though they think this is a great investment, they can't take it as it is. So what do? Well, they can insure the bond so that if the bond fails, they guarantee their money by getting paid by another entity. So they go to an insurer. So we'll go to this big institutional bank. We'll call this Deutsche Bank. And Deutsche Bank is willing to insure this bond. So they sell the pension fund a credit default swap. So let's say that the total bond's value is rated for $2 billion. So $2 billion is what the total sum value of the senior notes of the CDO are worth, okay? And that's what the pension is due for. So if this CDO were to default, Deutsche Bank sells the pension fund a CDS, credit default swap. And what this essentially means is that Deutsche Bank is going to take premium payments, just like an insurance payment. They're going to receive those payments every single month, or 2 months, 3 months, 6 months, whatever. And the pension fund pays those payments. They're good with that because the payments that they're making to Deutsche Bank are significantly less than the rate of returns on these bonds. But they also get the added safety of, if this bond fails, then they get their $2 billion, and that goes straight to the pension fund, and Deutsche Bank pays that to them. So Deutsche Bank will pay that $2 billion to the pension in the event that this CDO fails and they don't receive any of their payments. Okay? That's great. Now, there's a problem. Deutsche Bank and several other Wall Street firms, like I think the biggest one was actually AIG. So AIG was the big one, as well as Goldman Sachs. So AIG, they did this exact same thing, but they did it with hundreds of entities. They did it with hundreds of entities. So all of these entities are insuring the same bond for $2 billion. If this bond fails, then AIG needs to pay $2 billion to each of these dudes who are all making payments. Now, if the bond never fails, AIG is making crazy, stupid money because AIG is just collecting the cash without having to do anything. They don't do anything, and that's why they kept doing this. But the thing is that you count this up, this is $10 billion of insured parties. $10 billion that AIG has to pay out. And AIG might only have $4 billion on hand. So what happens if if this single bond fails? This pension fund gets their money first because they have predicate priority, but all the other investors, they can't receive their money because AIG defaults. And if Deutsche Bank did the same thing, then they would default too. They didn't, but AIG defaulted. AIG went down, and all these investors, they got fucked. All these dudes defaulted on their debts as well because they were paying massive premiums to AIG to insure this bond, and then AIG defaulted, and all of these guys got screwed. And this is the cataclysm that led to the financial crisis of 2008. This massive fucking disaster was caused by companies like AIG, Goldman Sachs, and several other big Wall Street banks that were doing exactly this shit, creating CDOs nonstop, filling it with dog shit, claiming that it was diversified and that it was AA and AAA rated, even though it wasn't. just by saying that as long as everybody's making their payments, then the senior notes get paid out. But if everybody defaults, nobody gets paid, and the bond is worthless. And that is exactly the problem that happened. And it's exactly like why in The Big Short, when you see Dr. Burry in his office explaining to the Goldman Sachs representative that the bonds themselves were worthless. So how can you not? How can the insurance payments not mature if the thing that it insures is completely worthless? Like that's the purpose of the insurance policy. So even Dr. Burry himself almost didn't get paid because everybody was defaulting. It's just all of these people were just there was just massive defaults going on all the time, and Burry got paid because he was one of the first comers to actually purchase these things and to get a device that would protect the investment of these CDOs and these MBSs. And that's the thing is other hedge funds caught on to this, and that's why this was able to happen because you had these pension funds that were trying to insure the debt of the notes that they were buying into. But you also had hedge funds that were also able to look at this CDO and say, I think this thing sucks. I'm going to short it by buying a credit default swap from AIG to insure that debt for $2 billion. I'll be happy to pay a few million every single month in case this thing fails. And if it does fail, then I'll get $2 billion bucks. But that only works as long as AIG remains solvent. And they didn't. And that's exactly what happened. This is the situation that caused Wall Street to completely descend into total freaking chaos. So now that we've had this lovely extended history lesson, I believe now is an excellent time to go back to the charts. Because now we're cooking up a similar situation for 2008. So 2008, our bubble was rather severe at this point. Having just come out of this bubble, we've got all of this lending that's going on back here through stated income and ninja loans and all sorts of crap that was going on through all of this. Basically, banks just giving away money so that they could take that MBS, put it into a CDO, trade it to whoever their investors were, and continuously collect huge sums of money, which of course the individual bankers were making massive commissions on, so they were wealthy, stupidly wealthy. And that was the problem that led to all of this. So before this point, S&P, most of the trading that happened on the S&P during this time was heavily weighted to this point at around $90 to $95, we'll say. This is where most of the average had gone up to in July of 2006, right? And as soon as we get up to the peak, notice once again we have the same situation. Heavy weight of the volume is almost entirely all the way up here. We're back up. We're all the way up above $110, and the support is right there, right at 110, almost exactly. And this is exactly what I said about the fulcrum analogy. You have a heavy foundation. You would normally have a heavy foundation, but now we don't have that because we just came out of a crash. There's no weight down here. There's no foundation here. Not truly. Because all of that investing that where all the value from the dot-com bubble had evaporated from, that was all the way back from before 1995. All that value, all those investments from 1995 are the foundation for this. Way back down here at like $50 frickin' dollars or lower on the on the SPY, and you have all of this volume that's way up here. So there's nothing to catch the price if this goes south and people start to panic. So at this point, we'll say that 11th of February or 12th of February in 08, the markets had a bit of a downturn. And if you go back to of July in 07, this is where massive defaults in the housing market were happening right here. So this is a big black swan event right here. This black swan event in June, July of 2007 led to rising default rates and caused a brief stock market panic that dropped a bunch of people out of the market. It recovered and rallied
because you had ratings agencies step forward and basically say, "Oh no, everything's fine. We've checked for this. These are within our models, and this is all okay." So there won't be as much of a failure as we had expected. So nobody panic. Everything's fine. The ratings of these bonds are still good. The housing market is stable. It's okay, even though the default rates were like above 8%, which is freaking ridiculous, and the delinquency rates were insane. If I went to the delinquency on credit cards and delinquency on loans secured by real estate. Look at these lines. Look at how rapidly these started to ascend. Now, this started back in 2005. In early 2005, these delinquency rates had risen up, and this is what Michael Burry saw. This is what Dr. Burry had seen. He was paying attention to the default rates, he was paying attention to the delinquency rates, but he was also paying attention to the fact that adjustable rate mortgages were going to be coming due in a few years. He saw that the mortgage-backed securities that were insured by or that were created by these banks were not being rated appropriately for the amount of delinquencies that were happening, and there was an incongruence there. There was just things didn't quite make sense, and people had been defaulting on their debts. Credit card debt was at a all-time high, and it was always being talked about on the news. Now, this massive rise peaked in 2000 and in mid 2007 when the delinquency rates were basically bell curving up, and the situation was starting to get out of control. Now, people continuously defaulting is an extremely bad thing. And considering that most of these banks, all of their liquidity was based on payments that they had received from their investors on mortgage backed securities. Their investors purchased mortgage backed securities from these banks that the banks did not have insured, and in fact were selling insurance policies in the form of credit default swaps to other entities because they didn't believe they could fail, and they laughed. They laughed about it. And then as things started to get more and more out of control, when the delinquency rates had risen up to 3.5%, and the credit card debt was above, the credit card delinquency was above 4.5%, this started to get more and more out of control. And then by July of 2008, when the numbers came out, notice that these drops all coincide with May and June dates. That's because this is when the major numbers come out after the Christmas season. My theory is that after the Christmas season, that's when people are most behind on their payments, is right after the Christmas season. But anyway, going forward into May, this is where things started to get out of control. So I'll go ahead and take away the delinquency rates because we pretty much get the picture at this point. And I'm going to go and get another volume profile on this. So we're going to fast forward to this point here. And we see that most of the trading that happened in this time period from early February to mid-August, there's not a lot of support here, okay? And why did I set up this big panic breakdown area? Well, it's mainly because of this. It's because this is where most of the volume had been traded up until that point, okay? Our prices, the price that was being traded at here was somewhere in between these two levels. So I just kind of marked out an in-between level in these two areas, and that's basically the bottom line. You know, we have this support here. The price did a double bottom here, and then that's when the rally happened in 2006 through 2007. So this seems like a good level, and it's right between these two areas in the bar chart or the volume shelf chart that shows where the support and resistance is. So at this point in history, if we just imagine, and in fact, let's go ahead and do a replay because that'll help with this. We're going to try to figure out when the crash is going to happen. We're trying to figure that out. We're an investor here back in 2008. It's late 2008. Things are sketchy as hell.
And we see that all of this volume that was traded up above us, this is all way, way above us. And this is now resistance because you've got investors here that are trapped, that are stuck in their positions, that want to get the hell out. And every single time that it touched this resistance after October, after we got out of October when it broke down, every time it touched that level, it broke down. And it broke down hard at that point. Like, investors gave up on that level. $110? No, we're not going to see that again. And it dropped by more than 15% in that time frame. Now we're here in this time period, and we see that we're touching resistance again. We managed to break out above it, but then we formed a head and shoulders here. Let me go ahead and zoom in a little bit so you can see this. Take away my info. So we had a big head and shoulders that happened here. Classic head and shoulders. And the price, of course, broke down. Got rejected. Big red engulfing candle. And we pushed straight down through this support. And now we're back down here. And we're thinking like, oh God, where's the bottom at? How do we figure that out? Better yet, how do we confirm that we're in a bear market? It should be obvious to everybody at this point that we are in a bear market, but like, how can we be sure? I'm going to use my moving averages. For one, we had a death cross, right? So we had this volatility behind us. This is where most of the trading was happening at the peak. This is where most of the volume is, on average, at the peak. We fell down below that level, and now we have major resistance here. We have major resistance up here. We have resistance here. And we're testing a level of support that we broke down and broke out above again. And we have this rising pennant. This is a big bear flag right here. This is bad news. And what's more is we are in a downtrend. This is a very clear, obvious downtrend. You can see it. We're trading below the 200-day moving average, the 50 below the moving average. So we had a death cross way back up here at 110. We got rejected off of it harshly, and we're trading far below. We're trading far below trend on all of our moving averages again. If we get rejected again, then this support is gone. And this is the only thing left to catch us. So let's just imagine we take a short position going forward to the next month that pays out at $90, or let's do $92. And we'll just play this out. Things are getting a little bit scary and volatile, but we keep breaking down and getting rejected. And now the crash. This is where things completely collapsed. So this was about the time where all the banks started to fail. Wall Street was in total disarray and collapse. People were not getting their money. And all in all, it was a really bad time. And now we have the history to tell us this and give us all of this information and let us know what we're in for if such an event were ever to occur again. So are we in such an event? Is this thing happening again? Because we're looking at possibly one of the worst situations that this country has been in since 2008, and possibly since 1929. And the reason why I say that is because now the Fed doesn't have any of the tools that it needs in order to protect us from something like this. See, the 2008 crash, the 2000 crash, that was caused by just a market correction that went too far in the other direction. And it was an unfortunate cascade of events where the tech bubble blew up and everybody who was invested in tech stocks got absolutely smashed. If you were in other sectors of the market, you would have probably been okay. You wouldn't have been happy because it dragged the whole market down. But overall, other sectors were okay. But tech got murdered. So it was a pretty isolated event. But nevertheless, it hurt the economy pretty badly. So then what do? We make it easy for people to get home loans. But the banks start taking advantage of that. They start over-leveraging themselves, and they start paying out insurance policies, or they start giving out insurance policies on the devices that they created that they themselves don't understand. And then when they become insolvent, they just default and get a bailout from the freaking government, which is what the Fed had to do. And then the Federal Reserve had to take over the rating system. They had to take over the mortgage lending practices. They had to institute the Dodd-Frank Act. All kinds of things had to happen to fix this fucking disaster that the banks had created for us. Now we have a whole different kind of situation, but it was created because of primarily a housing bubble. And just like in 1929, the crash was caused by a housing bubble, record high home prices. People couldn't afford to get a house, and people were running out of options. And the stock market panicked at the same time, and then the crash happened, jobs just evaporated, and it was a bad time for everybody. The 70s, that crash happened for its own reasons. Inflation was out of control. The Fed had to do something about it, so they racked up the rates till 20%. But that was okay. We were all right because the entire country was still solvent. We didn't have debt like we do today. We're tens of trillions of dollars in debt right now. I don't know how many people are aware of that, but tens of trillions of dollars in debt as a nation. That's insane. That wasn't the case in the 70s. The country was solvent. We had just come off the gold standard, but we were still solvent. And we were the world reserve currency. We still had great products. We had domestic product. And we still had plenty of goods and services that we were able to trade with in order to get ourselves out of that situation while the entire economy had to recover by bringing inflation back down below 2%. Took a long time, and yeah, the interest rates sucked, but people were able to survive because people were able to afford to get their common goods, and there was enough cash available. And the interest rates, because the interest rates were so high, people were able to take their money and put it into savings. And it's funny, but people made ridiculous returns. Like they made 18% on their savings accounts. People were making 15, 18% on their savings accounts, just dumping their money into savings and loan. And that's how we got out of that situation. But now we don't have any of that. We don't have any of that. We just had we came out of the worst financial crisis in 2009, which we still never fully recovered from because the homelessness and the job crisis still hadn't quite recovered. We were finally getting there, but then in 2020 when COVID hit, that basically put a huge reset on everything, and it halted all activity in the entire country, and we went into lockdown. And the Fed, I unfortunately have to be honest about this, but handing out a check to everybody was possibly the worst mistake they could have made. Because when we did that, we just put a whole bunch of free money out into the system that nobody had to pay for. And that when unemployment skyrocketed at the same time, that's a recipe for disaster. So just to illustrate my point, this was a huge anomaly where in January unemployment was fine. We were, I don't know what this was, like 3% or something like that. Yeah, we went from 3.5% all the way up to a freaking ridiculous 14.7% unemployment rate because everybody got fired simultaneously, and nobody was able to go to work, and we went into full lockdown. The definition of a black swan event. Ironically, that crash created the environment for the biggest rally that we have ever seen in this entire country because the Fed pumped out a stupid amount of money to individuals. And probably if that hadn't happened, the GameStop squeeze never could have taken place. There's some things that I think that Wall Street was right about, that if the government hadn't just written us a bunch of checks and sent us free money, that we never would have been able to cause the GameStop squeeze, because suddenly people had a few extra $1,000s of disposable income, and that went out across over 200 million American homes. And because of that, people who didn't need that money were able to do like something else with it, like, oh, I'll just throw it in the stock market. And there it goes. So the Fed kind of dug its own grave in this case because not only did they create an environment for massive inflation by putting huge amounts of money into the system, they gave it directly to the consumer and they gave it directly to banks and individuals that didn't need it. They didn't focus on the people who were actually at risk because they were in such a rush and such a panic to save everybody and be that cushion for everybody that they didn't consider the fact that they were putting all of this money out to people who didn't really need it. Maybe 20% of the people who actually received those checks should have gotten them. And I'll tell you what, if those people had gotten a bigger check, it would have meant more. And it actually could have stimulated the economy in a better way. It could have been done better, so much better. We can always say hindsight's 2020, um, you know, but it's just a fact of the matter that the Fed made a huge mistake when they just threw out all this money out to individuals without ever truly really thinking about it. I want to close this out by figuring out how exactly are we going to track this entire situation with the SPY right now because we are repeating history. So the situation that we find ourselves in is a massive overvalued market that is that is propped up with a massive amount of inflation. Our joblessness crisis is not over because the truth is that our CPI index is a freaking lie because the CPI index does not accurately track all of the commodities and the prices going on in the world and in our country. It doesn't account for real estate, which just look at the fucking median home prices. Yeah, median sales price of houses sold in the United States. This is new and old houses. The median price back here in the beginning of 2020 was $322,000. That was the median price. We are now at 428.7 thousand, and we actually had reached a peak in many states of 500,000. $500,000 median price of a house is stupidly ridiculous because we don't have the income. People don't have the income like they did in the 50s where you could just where the father could work a single job and pay for a house, pay for his mortgage, a car, all of his expenses and take the family on vacations 2 times a year. We're not living in that life anymore. We have people that are working 2, 3 jobs just to make ends meet. Both parents are working. They have to pay for daycare just to keep their kids safe, and they still can't afford the rent for the hovel that they're living in. That's the situation that we're living in for the majority of Americans who are in a bad situation. The Americans that were in a bad situation in the 50s had it great. Those were the people who were living paycheck to paycheck, but they were still able to go out and have a good time. They still had a car. They still had a house. They weren't at risk of default all the time. They just had to keep working in order to keep up with everything. And those were the people that didn't have a retirement savings. Now, the people who are hurting are the ones on the street. And that's the story of the majority. Yeah, and minimum wage is $7 and $7 an hour, $7.25, but whatever. Wages haven't kept up. Yeah, that's an excellent point. Wages haven't kept up. The wages they're so ridiculously low. Our interest rates are stupidly low. All of this free money got pumped out that was given, nothing for nothing, and the banks have been holding on to all of this risk because of this way overvalued housing market. So here is what I think is going to happen. I think that the housing market is going to lead into a crash, and that is going to precipitate a housing crash for several reasons. One, just the median price of homes is way overvalued. $500,000 makes no damn sense. There's no reason why the prices should have been that high in the first place. The problem is that just like with Just like with the stock market, the median housing price you had, if you could see volume on the median housing price and how many people actually paid that ridiculous sum of money to get into their homes, you would be floored. And the fact is that because so many people paid that much money at the top, they have all of their equity in their home. What happens if all of the prices of the housing market simultaneously start to go down around them? It's going to drag the value of their homes down. Oh, but let's not forget property taxes, because people that paid for a dirt plot, built a home on it, and then got reassessed, they're going to get a new jump in property taxes. You might pay value on a $30,000 empty lot for the first year that you're building your home, but as soon as there's a freaking house on it that's worth $400,000, that that 5%, 4%, whatever your tax rate is in your locality, that jumps from taxes on 30,000 all the way up to taxes on 500 fucking $1,000. That's a big difference. That's a big goddamn difference. So all of these people who are going to be paying through the nose on property taxes after being reassessed based on the new market highs, the all-time highs that we have ever seen in this country, and people are going to be rapidly selling their houses now, trying to catch this top because we see the inventory is returning. Inventory is returning. That is another point of this. We're going to look at the monthly supply of houses. This is measured in months of supply. Pay attention to this jump. November of 2021, we had 5 months of supply, which is considered to be healthy. Way down here, back in September of last year, housing supply was 3.4, which is considered an extremely undersupplied market. It's very low supply. 6 months is healthy. Between 5 and 7 months is the marker for like, okay, that's a good supply. Now we're at fucking 9%, which is oversupplied. And the listing prices of homes are coming down. The number of listings is rapidly increasing. You have a ton of homes that are coming out from construction. And I've noticed that permits are being pulled, or rather, builders, contractors have stopped pulling permits for new homes. They've just stopped. There's actually an excellent YouTube channel that I will recommend to everybody called Real Estate Mindset. I've been watching this guy Travis on Real Estate Mindset for the last couple of months, and this guy has a incredible amount of insight into the housing market. I want to give a huge kudos to this dude. Um, but I'd love to talk to him, honestly. I'd really love to talk with Travis from Real Estate Mindset about this, because what I think is about to happen is going to be one of the most cataclysmic events, not only in the housing market, but of our entire financial system. This has the power to collapse our economy and send us into another depression. And that's what I'm afraid of. So I want people in Health's trading floor to get ahead of this and be aware and try to do whatever they can to be safe, because this is going to happen. I'm 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 completely confident, even if it doesn't reach my all-time low levels that I am most afraid of. I am very worried about what's going to happen to average Americans just when the housing market corrects, because we have had ridiculous equity growth that makes no sense in a time where we should have been going through a recessionary period anyway, because we just came out of a pandemic. I mean, we should have been in recession for months. I'm just saying. So let's figure out how we can track this and get ahead of it. So again, I'm going to go turn to my trusty volume profiles, and I'm going to zoom out, and we're going to figure out where we're currently at. Okay. So starting a volume profile from November of 2013 up to the end of the COVID pandemic, this is where most of the volume traded. This is our foundation, okay? You consider this our foundation, right? So even accounting for this massive crash from COVID, this is the foundation where most of the trading is at. You can go down a little bit further back. You can see we've got a pretty strong amount of volume trading here below $200, okay? So this is our foundation of, this is where all the money is before we went on this fucking ridiculous ride coming out of COVID. And accounting for COVID and the brief recovery period, this is still part of our big foundation, okay? So we're quite confident in that. Let's take this all the way up to the peak of the SPY. Still got a really strong foundation. Way, way down here, okay? So I'm going to go ahead and take all of this data out because we know where our bottom is. I think it'll probably be a little bit higher, but this is good. I'm actually, I'll leave it where it was. Okay. Now we're going to adjust the volume profile to go just after we exceeded the bottom. Okay. Now this is accounting for the peak. If we don't account for the peak, most of the volume that was traded here, this is where the COVID crash came down and there was a bunch of buying support, so people scooped up money and people scooped up shares down here. If prices return down to this level, then this is probably the worst that we will see that I can imagine in a crash scenario. Just based on how strong it is here, we've got money all the way back to 2013 that's protecting us, that's lifting us up above $200 on the SPY. And the COVID crash is the support was tested and proven that there's plenty of support here in this area. So between $250 and $260, there's a tremendous amount of support. Even and there's still some down here below 240 to 210. So not a whole lot of volume down here. This is probably like people, whoever timed this bottom, like holy shit, they must have had a crystal ball. But anyway, the point is that there's a ton of volume below here and above here. That's our big basis of support. This is our foundation for how. This is our foundation for the entire fulcrum analogy that we're going to use again. Okay. So after the COVID crash, this is where the rally begins. If we take ourselves all the way up to here, we can see that we've got most of the volume is weighted up here at the top, above $410, or up $430, excuse me. So there's not a lot. There's not a lot of gap here. If we actually come back here, you still see all of this heavy weight down here at the bottom. There's additional heavy weight here at the top. So there's air below here. Just air. There's nothing here. The price was pushed up here just by people getting euphoric and shoving the price up as quickly as they could. People buying nonstop. And this is coincidentally, it's right as the first checks were coming out in August, September of 2020. This is when the first checks went out. So of course, rally from that point on, and we got 3 more checks after that. So this line that I'm setting up here, right here, this is the major support for the peak. That if we had bounced and stayed above these levels, then yes, this may have continued for a while. But that's not what we got. Instead, things kind of fell on their ass. So now we have this major area of resistance up here. Anything above this is just forget about it. The price is not coming back up here. $245 is not going to happen. That's just my assessment, not financial advice. You do what the hell you want, but holy shit, please be careful. Don't do anything expecting the price of the SPY to return back above $445. I don't see it ever happening again. Well, not never, but not until after we've crashed, okay? Everything comes in cycles after all. Our biggest area of resistance is above 430. I really doubt we will get up to here again, but if we did, we're not staying there. There's no way we're going above 445. 440 is going to probably be the highest we can hope for. I think that most likely scenario is we touch 430 max and then get smacked. And this is where the institutions are going to be selling. Now, I'm going to point out a few things that will probably upset you, rightfully so. But up until this point, if we zoomed in on all of this, what you will see is a lot of green on the volume shelf, demonstrating price action pushing to the upside. And you could also use OBV if you like the OBV indicator that I like to use a lot of the time. OBV will show you the same thing, big buying volume pushing up the price up to these levels, and then it started to diverge down, higher highs in the price, lower highs in the OBV. This is bearish divergence on the OBV. So this was our first clue that we had reached a peak. And honestly, you could have taken a sell. You could have taken a sell order here. You could have taken a short position here, and you would have basically perfectly timed the top. Lower highs, lower lows, big bearish divergence, right? So always take note of that. Always recognize this. Additional an additional indicator that I recommend for this is this is TMA RSI indicator. This is excellent. This is from a guy called Artie from a channel called The Moving Average, who I want to thank him so much. I've been watching his videos all week, and holy shit, I got a major education from this guy. But um, yeah, these are I got a fantastic education from that gentleman on how to properly use some of these indicators, and God, I really can't tell you how much I've appreciated it. But anyway, you see the bearish divergence on the RSI, that's the relative strength index, when the SPY reached its peak here at a high of 467, and then we established a lower high on the RSI, but a higher high on the price. This is bearish divergence on the RSI. So this was our first sign that things were going to turn around. And then if you look at the OBV, you can see that the price reached a higher high, but the OBV was at a lower low. This is a second confluence, or as a second indication that there is a reversive trend coming. And as well, the price is bouncing off of the 100 moving average, this orange line here. Every time the price touches this 100 moving average should be a moment where you're like, it looks like it wants to go down. So you think about it. You don't take a position, but you think about it. You look at this, you take note of it, you remember this. And then you note when it breaks down finally, this is the time where you're like, okay, this is a hard break through the 100-day moving average. You have bearish divergence on the RSI, you have bearish divergence on the OBV. Volume is increasing to the downside. This looks like a reversal. So this is evidence that we can see of the change of the market trend, which is kind of the whole point of me, trying to point this out to you. So we're way up here, but let's still just imagine that we're in this situation here. Now we returned back above 460. This was euphoria. This bounced off of a major area of support. This support down here, we broke through it and then jumped back above. But as soon as we crossed up above the 100-day moving average, the SPY started to fall again. And we fell for a pretty long damn time. Now, what I am looking for as evidence that the SPY is finally going to make its break to the downside is I expect the SPY to touch the 100-day moving average, or at least get pretty close. By the time we get up to this big resistance, this major resistance at 430, the moving average will have come down further. We are continuously getting lower lows on the OBV. The trend is down. The overall trend is down. The RSI is moving down constantly. We're currently getting ready to make a higher high, a lower high on the RSI. We just have to wait to see what the price does and when we finally get rejection. But what we're looking for, what we want to see as our confirmation that the price is coming down is we want to see the price reach up to one of these levels and then get rejected hard. Big fat red engulfing candle like this on a daily. You could look at an hourly chart and see something similar, but this is kind of the idea of what we're looking for. This big green rally is not going to last. I'm very certain about that. We may continue to go sideways and consolidate upwards for a little while, but overall, like, things don't look very good. It's going to take a lot for a reverse of trend. So what I'm going to be doing to track this and figure out when to take a bet against the market is I'm going to be watching my hourly charts for divergence to the downside. The market will eventually turn around. It's moving up right now, and the moving averages are breaking through on the hourly. On the daily, larger time frame, it's still bearish. All the trends are down. All the trends are moving down. But on the hourly, it's breaking up and through. So what we're looking for is for the price to get rejected on the hourly, and then that's what we use to say, okay, I think it's coming down. The hourly says that it's getting rejected. It's running into resistance. If we see resistance here and the price getting hammered back down, then we can consider taking a bet. We're looking for our big confirmation is rejection from the 100 moving average, rejection from major resistance. And then what I expect is going to happen, my imagination for how the rest of this is going to play is we have now tested the panic support level for the first time in this past week, and there's been a huge rally. I want everybody to know this is a bullshit rally. It's not real. This happens in every single crash. The news is talking about how everybody needs to be investing right now and everybody needs to be throwing their money long into the stock market to try and catch the next wave, the next rally, the next great investment, the next big move. It's not real. Please don't believe these people. The news is lying to us. They are seriously lying to us. The mainstream media is pushing a narrative that is saying that the entire market is about ready to go on its second run for the second time. It's not real. Inflation is above 8.8%, and the CPI index is underestimating it. We may be, if we were to measure our inflation against the old CPI index, we would be above 15% right now. And I had to take a sobering moment of clarity because I listened to a video by Peter Schiff, and for the first time, I agreed with the things that he said, that inflation is here to stay. It's a telling thing. It is a telling thing when you listen to your enemies and you listen to the words of people that you hate and you realize that they're right. Peter Schiff, I hate the guy. I think he's pompous. I think he has an overinflated ego, and I think he looks down at people that have a bank account less than $100,000 in it. But when it comes to the economy and the fact that he has pointed out that the Fed has backed us into a corner from which it cannot escape, and that the only way out is a massive market crash and to raise interest rates to historic levels, it's the only way out. A market crash is the only way out of this, and it will come. But the thing is that remember who owns the media. Remember who controls that. They control a narrative that will convince people to buy in, and it is bullshit. All the markers are here of a massive economic downturn. Housing prices can't stay here. The price of goods cannot stay where they are. The cost of living is too high. Homelessness is rising. People are going to default on their mortgages. Mortgage-backed securities are going to lose their value again. All of this is happening at the same time when the Fed has no tools left to protect us. They can't print any more money. It will only make it worse. So, I am watching the SPY very carefully. I am going to be watching the market to move up to this resistance at $430. When it reaches that level, it is going to get hammered hard. All of those institutions that have still got anything, any equity in these levels are going to sell it. Anything above these levels is where institutions are going to dump their bags. Don't be a bag holder. Move with the trend. Find the trend. Use moving averages. Find when the trend goes in your favor and follow the price. Don't try to be smart. Don't try to overthink it. Don't try to hold on to denial. And for God's sake, don't risk money that you can't lose, because Lord knows you're going to fucking need it. We're all going to need it. What's coming is going to be one of the most tremendously disastrous events in our entire country's history, as far as the economy is speaking. Please take this with a grain of salt. I can absolutely be totally wrong. I am an amateur investor and I am not a financial advisor. I can't promise anything and I can't insure your money or anything like that. You have to make your own decisions. But learn this stuff. Learn how these moving averages work. If I had learned this shit, if I had figured this out back when AMC was squeezing, I never would have stayed in at the top. I never would have stayed in at the top. I would have understood that the trend was turning around and I could have made money. I could have helped people make money when AMC turned around on us, and we could have sent it back up from the bottom quickly. If I had learned to trade, if we had learned to trade better on this situation from AMC, SPRT, BBIG, RDBX, Progenity, there's been so many squeezes that I've been right about, but I never exited smartly. And I don't want anybody to suffer that problem again. This weekend has been the most educational weekend of my entire fucking life. And I owe it to guys like Real Estate Mindset and Artie from the Moving Average showing me all of these things. Never, ever, ever, ever stop learning. Never stop learning. I have learned so much this weekend. And I am so grateful for, although it was an expensive lesson for me to lose on so many trades that should have gone so perfectly well, that I called and timed the bottoms on so well. I could have done it better. And it's because I realized that I wasn't perfect, that I didn't have all the answers, that I went back and I retested my thesis and I looked again at where I went wrong. And everybody should always do that. The stock market will test you. It will test your theories. And you must have discipline and you must have the self-awareness to recognize when you've been wrong and revisit your theories in order to find what's wrong with it so you get it right next time. And that's what it's all about. We are here to give ourselves financial independence, and we are here to create a new generation of wealth that will be more responsible with the world that we live in, more responsible than the Wall Street banks that took control from us. That's what this is about. That's what Hell's Trading Floor is supposed to do. We are here to take power back and put it in the hands of retail investors who will be more responsible with it. I'll ask people once again to take this with a grain of salt, and please educate yourselves on this in order to make sure that you're understanding it, not just trusting my word, because trusting a YouTuber's word is exactly how so many of us burned ourselves in the first place. It's a bad idea to just trust somebody, because at the end of the day, I'm still an amateur too. So here's how I'm playing this. Once I see the rejection from 430, the price is going to start to push back down to the downside. I am not going to be taking puts against the SPY. I am instead going to take leverage bets. My bets are going to be with SPXS, which is the direction 3 times leveraged ETF inverse of the SPY, or the S&P 500. So whatever S&P does, SPXS does 3 times the opposite. So if SPY goes up 10%, this goes down 30%. If SPY goes down 10%, this goes up 30%. I'm waiting for SPY to reach its top, and then I'm going to be taking a bet on this exact ETF. Long on this ETF, a long bet, a call, whatever, buying stock on SPXS is a bet against the SPY. It's a bet against the stock market. I want everybody to understand it. Don't invest in these devices if you don't understand them, okay? Must be clear about that. Don't invest in it if you don't understand it. Don't be prideful. Don't think that you're going to figure it out. If you don't understand it, if you are not 100% confident in your ability to understand, and if you do not sanity check with somebody to make sure that you understand, if you don't ask somebody who understands to tell you that you understand, don't do it. Don't invest in this. Don't do this. Also looking at SDOW. This is an ultra short against the Dow 30. This is the US Wall Street 30 top stocks in the entire country. If the entire stock market dumps, I expect the Dow to perform extremely poorly. The thing in common with these is that if you had taken a long bet at these in the if you had taken a long bet in SDOW or SPXS or or any of the other inverse leverage stocks before the COVID crash had hit, then you would have more than tripled your money in a month. That's how powerful these things moved. If you had if you timed your bet perfectly against the market when the COVID crash had hit, these could have tripled your money. But you have to be careful because these lose value quickly. These are always losing value over time unless the market moves down. So that's why timing is important, and that's why you can't take this bet if you don't understand it. And that's why I want people to be so super careful. I'll be looking at other plays as well, and I'm going to be extremely watchful of the state of the market going forward. There are still several squeeze plays that I am going to be paying attention to, but I'm going to be using the things that I learned from my from the education I received over the weekend. I'm going to be using all of this information that I have obtained to help people time our bets more carefully. I'm not going to be throwing money at the wall, hoping it sticks like I was before with squeeze bets. Even though ScourgeBot did predictably choose squeeze bets, it took a long time sometimes for them to play out. And my biggest mistake was options. I'll just be honest with everybody. I bet long into options for stocks that I didn't know when the squeeze was going to happen. I just knew that they would eventually happen if the trend kept going in our favor. When in reality, the way I should have played it was just to buy stock and hold on to it while it was at its low point and just wait, and then wait for the confirmation of my trades before I purchased the options. I spent so much time worried that I was going to miss out on the squeeze that I bought options way too early, and it bled my account really badly. So I'm just being honest with everybody that even though I've called these squeezes so many times, I've overall lost a lot of money. So, and yes, I know I'm recording this, and this is going to go on YouTube too. That's fine. I'm okay with that. I feel like I need to be transparent with people. I was really worried about it for a while, but I've lost a lot of money just because I didn't exit my positions. I was in on my squeezes, but I took options bets that were way too early, and I held on to them way too long because I was really dumb. I didn't figure out how to exit properly. Collar strategies worked out really great, but they could have been better. So I'm reevaluating my strategies and figuring out, how how I can do better, and I'm going to help everybody do better too. I think we all need to I think we all deserve that opportunity to learn from these. So these leveraged ETFs are constantly losing money because they are in order to get the leverage to bet against the market, the company that created these ETFs has to buy swaps and devices which are constantly draining cash, and they have to restructure it constantly. So that causes an event called drift. And a drift in the account is that essentially the devices will slowly lose money over time because you could think of it like taking. It's not that different from a CDS, like credit default swaps, insofar as you're making payments constantly. That's what this ETF is doing. It's making payments constantly, and it's shuffling around risk and restructuring its books so that it is able to always maintain a 3 times leverage against the market. And since this ETF is up every single day, they don't just take a bet when the market is green or when the market is red. They take it one way or the other, no matter what. So that causes drift, and the price on the long term loses money. And in order to keep restructuring it, they split the stock repeatedly, which is why these ridiculous prices that you see here are here. Like if you go all the way back to the beginning of XPSX's history, the value is like, yeah, you don't want to hold this forever. I'm just saying. If you spent if you bought SPXS at the first day of its history at $78,000, you would have $21 today. So yeah, don't hold this long term. That's what I'm saying. Um, but that is what drift is. So that's why these lose money all the time. It's because the restructuring of the devices that cause the leverage to or that create the leverage are a constant drain. So it continuously devalues. So that is one of the most important things to keep note of when paying attention to this market. But I do want to illustrate what can happen when you get your bet right. Like if you heard whisperings that that there was a new virus, some novel virus going on in like February, and you took a long bet in late February, like, this feels really weird. Like this might affect the stock market. If you bought a single call in this at, it wasn't $130 at the time, but um, because of the splits and everything and the restructuring. But if you had taken that bet and you let's not say you could time the top. Let's just say here could have made a 78% gain in a single month, almost double your money. If you took a call, you could have probably multiplied your money 3 times. But that's why timing's important. Timing's very important. So anyway, um, UVixy, yeah, that's a short against the VIX. That's a leverage bet against the VIX. You could do that too, but that's betting on volatility. I don't really do that, so I don't trade the VIX or UVixy. Um, but I'll leave that to you guys to discuss that on your own. SDAO works the same way as SPXS. It has drift, it loses cash over time, and the value of it will decline if you wait too long. So you want to get your entries as good as possible, and part of that will be figuring out how to determine when the trend is in your favor and when selling pressure is going to push a stock in a certain direction. And that's how you play these devices. So I'm just going to go ahead and say it. I got a tremendous education from Artie from the Moving Average. So I just want to like recommend everybody if you're interested in day trading, like I was never interested in forex trading or anything like that. That's primarily what he does. He trades forex, but he's an excellent day trader, and his videos were so good. I enjoyed every single one of them. It was so enlightening, and his strategies that I have found applied so well to my squeeze picks that if I had had his strategies, I not only wouldn't have lost money, I would have gotten my entries and my exits almost perfectly every single fucking time. So his channel's worth a look. Like, he's got a great channel. I'll just, I don't mind giving credit where credit is due. The dude has a really great educational channel on day trading, and a lot of his stuff plays into other things in the stock market too. All the principles still apply. We got any other questions?
What was his name, Trudine, again?
The Moving Average is the name of the channel. The host of it is named Artie.
Oh
And
yeah,
his
I think you've
community
heard of it.
actually created this RSI divergence indicator that I'm using as well. I'm quite enjoying using this. I've been practicing with a forex paper trading account, and I decided to do a little challenge, and I was able to grow a $20 account up to about $140 in a few days. So that was a pretty fun experiment.
I want to thank you for doing this. This is really informative.
Yeah, I'm
Really,
happy to do it.
what I was, I guess, most, I guess, shocked by or impressed with was your analysis of the housing market, and it's not so much, that right now that the lenders' standards have come down, or that builders are even going to build more supply, but it's just as the market crashes, the houses get listed that exist. Listings go up in a hurry. And that's the big thing I think that gets missing. Because when I saw some analysis, like some economists, and so-called professionals, analysts, they say, well, we have a lot more savings. Everybody has a lot more savings, and the builders are a lot wiser, in terms of not building new homes. But the problem is it's not just about new homes. It's about people's mindset and thinking that, like I said, that if they're going to lose out, they start listing their home. And suddenly the existing supply starts having a lot more listings in it, which could turn it around even without the other, added pressure.
Yep, absolutely. And it just to kind of reinforce the point that you were making is I wanted to point out the real estate sector. This orange line is the number of permits pulled on new family home builds that skyrocketed all throughout all of this period. 1,213 homes that were getting pulled. All these permits are still being pulled. This is the number of permits being pulled in real time. So we've got thousands of homes coming out onto the market. And it's a serious it's a serious increase of supply. Uh, those guys are probably going to be stuck with those houses too, because those construction companies like D.H. Horton and Lennar, they got to finish those contracts. And if there's nobody, if they built those homes, what's called on spec, if they built it on spec, which is they've speculated a buyer will come if they build the house, and there are no buyers, then they'll be screwed. They'll have to drop the price of that home well below what their profit margins were in order to get out of it, because they can't hold on to empty homes. It's a huge wash for them. It just
Yeah,
costs them money.
absolutely. Yeah, they have to. What a mess. But are you going to change the scoring bot to then? Is that what you plan on doing to reflect what you've learned?
I'm going to continue. We will keep working on ScourgeBot nonstop for sure. And I don't want to. I don't want to say I'm going to do it because it's mainly Flabbergank and Goober and Dave that have been working very hard on most of our tools. So, and Verde as well
Yeah, I,
with
I
his
used us. I guess I
stuff.
should say the scourge bot. Sorry, it wasn't necessarily you. I meant in changing
I just don't want to take credit
the
for it
tool.
because I've barely written a single line of code in that thing. I would love to write more code for it, but uh, currently I've hardly done anything. But
Not
yeah,
me, not
you're
me, not
to
me to
answer
diss
your
everybody else because I totally appreciate what Flab and Dave and I forgot who else worked on it. So to those guys, kudos. I mean, I didn't mean to imply anything by it.
yeah, no problem. I just wanted to make sure I was giving credit to those guys for their hard work. But yeah, to answer your question, I'm going to be continuously using ScourgeBot and um, improving it so that we can. I want to keep improving it so that we can track these trades better. Um, but I do think that ScourgeBot, as it is, it's very good at signaling squeeze candidates. But now, what I have with the education that I have I've gleaned from all of this is finding excellent plays and excellent signs when a squeeze is going to occur, such that individuals can take a much better entry. I can't go back in time to look at SPRT, but I could look at BBIG, for example. This is one that would probably be a good one to look at. So before I was just looking at like the candles by themselves without really taking into account moving averages and things like that, and RSI divergence. I was mainly looking at on balance volume, which was that was great, but like on balance volume showed you the move after it happened. So it's kind of a lagging indicator. It doesn't really tell you things ahead of time, and that kind of sucks. So I needed to see when the trend was moving in our favor. So I decided to look for other ways to do that, and I landed on this series of different indicators that I feel really helped with that thesis. I've also figured out how to use TradingView a little bit better lately. So I'll go back and look at BBIG, and I will see some things that will help with the thesis a little bit. So not going to really pay attention to STC right now. Mainly what I want to look at, I don't even necessarily want to look at the RSI divergence right now. What I want to look at is these moving averages. The moving averages are a lot more telling. So here's the thing. BBIG moved up into an uptrend on the daily back here in May of 2021, and this is a sign of a big bullish trend. Now it started to retrace, and it found a bottom down here when the price kind of just like started to collapse a little bit. But what I found interesting was that the all the squeezes that I have looked at, the moving averages rapidly jumped up and had these huge gaps between them, and then they would retrace back to their previous lows before it suddenly just took off and just through the stratosphere. And I could go back at AMC, and you would see something very similar in both January and in June as well. So like if you actually follow the squeeze in January and see how the moving averages moved up like this was a bull trend. This is a bullish market because the moving averages showed it going up. And what was interesting is that the price went and touched the 50 and then bounced big time, and then tried to go back down and then bounced again, and then it took off. It was like taking a springboard, like it was taking a running jump at what's that Olympic event where they like run at that barrel?
Vaulting.
Yeah,
With the vault.
yeah, the vault. So it's kind of like that situation. Like they get a jump and a running start, and then they finally like they do their tumble and go straight for the fucking moon. And that's what this represents. These moving averages are representing the price's direction over time, and it showed bullishness, like it proved it. And now, unfortunately, we don't see that anymore in AMC, and that it's kind of disappointing. But the price collapsed after here, and I never really understood why, but I understand now that the moving averages showed me. The moving averages would have showed me these things, and I could have seen this coming.
So it looks like the idea of AMC squeezing is highly unlikely then, based on.
I don't know. I don't know yet because this play isn't over. You still have a whole lot of retail. Like the price returned back to a previous level of support, and it rejected the support. It bounced off. It was a hard acceptance of the support level. We had a double bottom back to back, and we moved up again off of what was previously a high. This was significant price action. This meant something. So I'm not going to say that the squeeze is unlikely. I'm just going to say like the price action shows that AMC heavily rejected that $11 and $9 price level. It didn't want to go back there. It refused outright. And fundamentally, the company is in better shape than it's ever been for the last 3 years. So no, I'm not going to say that the squeeze is unlikely. I think the squeeze is still a plausible scenario. I want to be very conservative about my approach to it. I don't want to just throw all my money into a bunch of calls that are expiring next month, like the ones that I'm holding now because I bought them several months ago like an idiot. I bought them when we were in this downtrend and I never waited for confirmation. And that was a mistake. I shouldn't have
And
bought
you
those
think
calls.
we just confirmed essentially the bottom is what you're saying now?
I
We're
think this
now
is confirmation of the bottom. Yes, I think that this is
okay.
confirmation of the bottom. There's other signs that we could still get rejected. Like we had this situation here. This is not a double bottom, as I found out. I've been reading double bottoms wrong for a long time, but this this wick uh, that we've this wick that was created by this candle, we closed at the bottom of this level. Um, and the price did bounce up off of it and it rejected that level, but it ended up coming back down to retest it and broke through. So, oh, I take that back. I take that back. It is a double bottom. The important thing is that this candle, if it's a double bottom, this candle will not close below this wick. I thought that the candle did close below the wick, but it didn't. It wicked down, but it didn't close below the wick. So double bottom and a big green engulfing candle and run to the upside. If I had known this, information on how to read this, I could have taken a long position after this day and like at market open on the 16th, and I could have taken calls on this and ran it to the top. And now I see this information. Now, having spent the time to educate myself and learn more, it's been really great. So now we have another situation. This is another double bottom in AMC. This is another likely scenario for a double bottom because you have
So then,
this.
my thesis was completely, or my question was probably the opposite. Probably that it's. I was looking at it from what you were saying about the EMA. We don't see that, and so that's why I was looking. But you're saying that basically double bottom indicates.
Yeah. So I'm actually in a very bullish mindset for AMC. I think that since it rejected this level, and we have this big green engulfing candle. This is in fact a 3-line strike pattern, 3 bearish candles
Yeah.
and then one big green engulfing candle. This 3-line strike pattern, I've looked at this when this is a big reversal pattern. This is a good pattern, and it's usually followed by a 3 white soldiers pattern in a true reversal fashion. And like you see it here, it's not
Yeah.
quite a 3 white soldiers, but still, this is a very bullish rising. I think I forget if this is the rising sun. I can't remember the name of this candle pattern, but this is a very bullish pattern. Tomorrow, I'd feel really great about some calls on AMC. I really like it. If it breaks, this, if you want additional confirmation, it needs to break this red candle and close above it. So we need to see it close above 1560 or higher, or not tomorrow, Tuesday. Tuesday. Sorry,
I know
Memorial
the
Day.
first trading day back. That's what you meant.
Mm-hmm.
I know what you meant.
Gotcha. Cool. But anyway, yeah, AMC feel really good about it. This
Do
is
you
big
think
confirmation.
we're still following the SPY, or do you think there's going to be some divergence now?
I think the AMC will begin to diverge from the SPY. I think that AMC has been diverging from the SPY for a significant period of time. That's another
Basically,
catalyst.
OBV.
GameStop is holding their earnings call, so
I'm just
I
saying,
forgot about that.
GameStop too. I assume GameStop is also paralleling AMC. Probably, I'm pretty sure the same thing, right?
Yeah, let's actually take some time to look at GameStop as well. This is another situation, another example of a double bottom. See this? We have the bottom of this candle. So this big red candle, that's where the bottom is. So we draw it to the bottom of the wick. Probably haven't got it quite right, but close enough. The point is that the next one, it wicked down, but it never closed below it. It closed inside of this zone. So as long as it doesn't close below the previous candle's body, or below the previous candle's down wick, I should say, then this is confirmation of reversal. And now we have another confirmation. Here's another 3-line strike. Red, 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 big green. And it broke through a previous area of support, or resistance, I should say. So now I feel so good about my education that I've gotten over the last couple of days. I'm so excited to see how this affects my trading going forward. But I'm feeling really good about the next coming months, even though we're about to go in possibly one of the worst financial crises of our lifetimes.
Well, that's yeah. I was asking like what you thought, like AMC gave individuals from it, like those two specifically versus the SPY. Sorry, go ahead, continue. Just I was curious what you were thinking, even despite the correction of the SPY, the potential correction.
Yeah, it's I think that there is a legitimate case for the belief that GameStop and AMC will be detached from the SPY, from the stock market. I think that that's a very plausible scenario. Another run up. I don't know if we'll go back to these all-time highs like we did before. I don't know. I don't know what MOAS will look like. I don't know if that was MOAS for all I know, but I do I do feel that we can learn to make money in this situation, and we can be consistent, and that's my goal. I'm not going to do these. I'm not going to do stupid bets anymore. I'm not going to take these YOLO plays. I'm going to look for confirmation. I'm going to make good entries. I'm going to make sure that when we buy our calls and our shares, that we are buying it in stocks that are proving that they are moving in our direction. We're going to start changing our strategy. We're going to start making fucking money. We're not going to be taking these dumbass YOLO bets anymore and then screaming hedge fuckery every time it doesn't go our way. It's just not going to work. And the fact that my portfolio is deep in the red is only evidence that I've been doing things the wrong way. And even though I can call squeeze plays more than anybody else, doesn't really fucking matter. It doesn't really fucking matter.
Yeah, not if you exit, not if you don't take your profits, right? That's
Yeah.
what you're saying.
If you're not taking good entries and
Yeah.
you're not taking your profits and you're entering in options trades that are way, way, way too early, you're just going to bleed your account dry. So I'm changing my whole strategy and my whole outlook for this entire market. Fitzy called out the cycle on GME. I'm feeling it. I'm feeling it for sure. We'll see how it does with earnings, but I'm going to wait for this confirmation. What I want to see is for GameStop to move its moving averages up on the daily and make a bounce, make that springboard bounce. It did it once and then it broke back down, but what I want to see is up and pop, and that's the confirmation that I want to see. So we'll get there. We'll get there. It's a good idea to pay attention to the moving averages on a shorter time frame because then you can see the trend going in your direction. So if we see GameStop trading down and then bounce off of one of these, either the 50 or the 100 on the shorter time frames, like maybe an hourly chart, then that would be a signal of confirmation. So right now, the 50 is about to cross above the 200 moving average. So this is a good sign. There's a golden cross right here on the hourly for GameStop. And the price is moving in the right direction. We're going in the right direction. All the lines going up. That's what we want to see. So I'm going to go ahead and cut things here because I'm going to have to take the time to cut this video over the Memorial Day weekend. And we're going to release this tomorrow, or not tomorrow, Tuesday in the morning before market opens so that people can get some of this information as well. But yeah, I'm looking forward to how this is going to change everything. This is going to change absolutely everything.
Everybody have a great weekend, like you said.
For your
Thank
time.
you. Really appreciate the host.
A lot of good info. Thank you.
You guys have a good one.
Yeah, thank you.
Have a great weekend.